All right. Good morning, everybody. So today's non-farm payrolls, it's the big one, really big deal. Um, the consensus is really low. It's 225, and the previous number was 339. So they're expecting a considerable decline here. Um, if they're caught off sides today, we're going to see this sucker move. That's the baseline bet that they better get it right. We have a lot of Fed speakers today as well, not just here in the US, but around the world. Bank of England and European central banks. And that's going to wrap it up for us by the morning. Um, we'll be done with everything that we've got, and that'll just give us the afternoon. For you 0-day traders, that ought to be pretty good because you don't have to worry about any shock and awe or surprises in the second half of the day. This really is one of the hot ones. And if you've seen the morning briefings for a while now, you've probably heard me talk about liquidity gaps on things like CPI day, PPI. Um, we have the same opportunity or setup when it comes to non-farm payrolls. So every expectation that we're going to see a liquidity gap today, which is a nice trade. I mean, it's a good way to get day done first thing in the morning. So we're on a weekly chart of US dollar Japan around that 145 area. It did hold as resistance, but it's worth noting, the last time we were up at that 145 area, and you can see the big wicks there, how they were defending that high, really not wanting to see it get beyond that level. Japan, of course, runs the yield control, which they held at 0.25% for a long, long time. And then during this right here, they decided that 0.5 really wasn't too bad. And so they were letting it do that, but they were still trying to defend. And so in September, they ran intervention. And then in October, they ran intervention again. But that time it was a coordinated effort with US and others too. And it did the trick. That was the October lows in the S&P. So um, the fact that we got to 145 and now for the second week, we have pulled back away from that level without the really big wicks from back here is, well, I guess it's a two-edged sword. Right now, if we close inside of last week's range, we're going to be inside week. If we open next week, also inside this range, we will at that point be IX10. The distinction might not be too great on one side or the other, right? It's just IX10 is just another way of saying inside day for multiple days in a row. And when the day that you're inside of, or the week in this case, when it's something really big like this candle here, it's not all that present or exciting and whatever. It's a monster candle. Of course, we're inside it. But when it's a spinning top and then we're inside and then we're inside it again, it implies this compression is taking place. And of course, what we're looking for at that point would be maybe something along the lines of this right here, where we were inside that blue candle and then we spent 2 weeks inside of it before we came out of it. And look at the expansion on that. It's nearly 3x the size of this range. Definitely a 2x the range. So really tight compression here at that 145. And if they didn't get the job done and we happen to break through that 146 kind of line in the sand, I think we're going to see an intervention again. And it'll be as coordinated as it was back in October. I really believe that with that event that we had where Yuta came out and spoke English for the first time and participated on that global stage when he was right there with Powell. You think they didn't collaborate a little bit? I do. So we'll see, right? It's just something I want to continue to point out. Keep your eye on US dollar Japan. It is as valuable as an indicator as anything else that you could get, right? Second only to reading price itself and looking at the clock. You can see that the chart looks very similar to US dollar China, right? So it's kind of the same deal. The bullishness of it, right? That rise from, say, around March, just a constant nonstop push higher. The difference, though, is that US dollar China is already getting up into this zone. And if you've kind of gone through any swing high, swing low, or rally base drop sort of material, you'll know that these wicks, right, kind of have their own little connotation for how we would lay out the structure. Now, freshness matters, being able to recognize liquidity, dropping down some proximal and distal lines, that's all well and good, but freshness is a real big deal. Without it, you would be marking everything always, and then you're just going to feel like you're never able to really see price go anywhere because, well, you got zones all over the place. Which zones becomes important. So we did get to the proximal line. We're going to see if we can get through it. And then if there's going to be any defense across that zone. It's interesting at the volume level there, right? That breakout with volume. It's exactly what they tell us to look for, right? Or say back here with that buildup of volume before that massive breakout. So the whole precious metals of 2023, that is dead. It died with the whole Buffett goes to Japan story. And until something changes, that whole precious metals theme is gone. So it's still sell the rip in all the precious metals and miners, silver, gold miners, until you see US dollar Japan finally take that smackdown. Right now, if we can stop this runaway freight train, especially say around that 148, and we get the rejection that we're looking for and the move to the downside, then gold and silver and precious metals are going to be a long. But until then, they're a short, or at the very least, they're a not long, right? Playing neutrals. The move in bonds yesterday was impressive. When you put it onto the whole week, it really just kind of almost is a wow situation, right? Like back here on the 4th and here again on the 17th and then here, right? On July 3rd week. Those are really big weeks and the week isn't done yet, but that's one heck of a move. We're not quite at that level where we would say they have to defend or else, but it's getting pretty close to the or else. You can see how strongly they defended back in February, right? With that, what you want to call it, a graveyard doji. It's certainly a reversal candle, whatever kind of doji we want to refer to it as. And the low of that thing is 122.24. We'll just continue to keep our eye on this. We want to see things calm down a little bit, right? Yesterday we had stocks and bonds both moving in the same direction. So that whole 60-40 thing, right? We've talked about that. I like somebody said it yesterday. These aren't my words, so don't give me any credit for it. They said risk parity died with COVID. COVID killed risk parity. And all I could think of was that South Park episode, where they keep talking about you killed Kenny. I don't know. Maybe I'm just a nerd, but risk parity's dead. And apparently, according to somebody else, COVID killed it. I like it. All right, so short and sweet calendar. The rig count this afternoon, I worked on those rigs for most of my adult life, and the number doesn't change very often. And when it does, it's usually when a whole fleet comes online. We'll see, a dozen or so new rigs pop up in the system, and if there's something wrong with that new fleet and they gotta, take it offline, then you'll see a dozen or so rigs drop off. But otherwise, then that number shouldn't change too much on a day-to-day basis, especially now in the last decade, where the US is actually an exporter of energy. Back when I worked in the patch, jobs were precious and scarce because if the price of oil got too low per barrel, they would just start stacking rigs in the dirt. They didn't care. You're fired. So we talked a little bit at the beginning that this is the opportunity today for a liquidity gap. And for anybody who hasn't seen the example of it before, it's a little hard to grasp. Better examples come from CPI day. Here's scheduled releases for CPI day. The June one was kind of a dud, so I was going to go maybe to May or April. So we're going to look at May 10 in this example as well, but I have the non-farm payrolls marked. This is June 2nd, and this one's kind of a dud. This is what we don't want, right? So if we get something like this today, you'll automatically know, okay, this isn't what we're trying to get. And I'm going to get off of the 15-minute. I think the 5 just shows things a little bit better. So June 2. I just passed it. It's a little lag here with Thinkorswim. It's not happy about what I've got going on. All right, well, it's still loading days, so we'll just give it a minute and let it continue to load days. I just asked a lot out of it. It's gotta give it a second. That's not me moving the chart, by the way. So if you're wondering how we'll know it's done, the chart will quit moving. There we go. All right. So this is April 7's non-farm payroll. That was actually a Friday, and we were closed on that Friday. So it's weird that there's no day that day. But even on a closed Friday, you can still see the reaction out of the market and the exaggerated move. So that was Friday, April 7. Here's the May 5 non-farm payrolls. And again, this is a great example of what we don't want to see. So 8:30 came in, we got the data, and it just shot down and came right back up in the very next candle. There's no gap close here because the gap is already closed, right? There's no liquidity vacuum, nothing like that. It's nothing. So we don't want something that looks like that. But since we're already in May, we can just go ahead and go from May 5 to May 10. And this is CPI day, May 10 CPI day. This is what we want. It doesn't have to go up. It can go down too. But this is a perfect example of what we want. So at 8:30, the data comes out. We go in one direction, hard and fast, not these big wick candles where, it went both up and down. We don't want that. Single direction drive. preferably closing in the highest part of the candle. We don't want that candle to close below 50%. So even the amount of wick here, this is a beautiful setup for those that want to jump in it while it's actually going. I don't, but to each their own. That's a beautiful prime play, but let that one go. Just kind of focus on where we started. So 8:30, the data comes out, you mark that level because that's where we're going back to. That's where the gap began. And I know you don't see a gap, you see candles. So, hey, Sig, what gap? It's a liquidity gap. We're coming back to that level. So you get the big push, you let it base, whether we went down or up, you let it base. And a good rule of thumb is just let it get into the open, right? Just get into the 9:30 open and then trade it back to that location. Now, what we've had the last few times we've seen this move, we actually had the follow through to the other side, right? This is just one, but if we were to go back and look at non-farm payrolls where it did have the liquidity gap, it also had the overshoot in the later part of the afternoon. And it's almost a perfect representation of the bounce. So if we were to measure this bounce and then project that to the downside, it lines up really nice. So it's a little interesting that measured move worked that way, but it does. So cool. And that's what we're going to be looking for today. And again, it doesn't matter if it goes up, doesn't matter if it goes down. It just matters that it's a good, clean, very strong, very big candle, right? Preferably a 5-minute, because that's what example we're using here. You can go to any time frame you want. It doesn't matter. But if you're trying to validate, is today's non-farm payroll giving us a liquidity vacuum or not, you've got a 5-minute representation of what that looks like. It's always good to see what it looks like, a good example. But I think that showing a failed example is always a good way to go. That way there's no doubt or confusion about it. Like, well, what about this? It kind of sort of, the better the setup, the better the conviction, the better the follow through. Candle recognition platforms, say like Thinkorswim, I can tell Thinkorswim to show me a flag. And some of the things that it shows me that it says is a flag, I don't think it's a flag, right? And if I've got to close one eye and tilt my head and squint to maybe kind of sort of see that it's a flag, then nobody else is going to see that it's a flag. And if nobody's trading it as a flag, then it's the chicken and the egg, which came first. Did price move because the flag was there and was recognized and traded? Or would price have always moved that way, whether there was a flag or not? You really want to trade patterns that are easily recognizable by the masses, right? So here's non-farm payrolls, and there's nothing, right? This is a great example of what we don't want. So it's just a big candle in both directions. And when it was all said and done, the gap was closed within 20 minutes. We had data at 8:30. The gap was closed at 8:50. Dusted and done. Plus, there was no play here, right? Price was so compressed within that entire range that you wouldn't even have wanted to take it, because how would you know if it's going to be a long or a shorter if we're going to get that gap closed? Price would have every right to run inside that candle, and both longs and shorts wouldn't know that they're on the right side of the trade. So like, okay, well, I wouldn't want that one. So that's a good example of what we don't want today. Surprisingly enough, with non-farm payrolls being such a really big deal, the volume's up this morning above 100. Now, I was a little taken back from that. I had anticipated that we would be in this muted market that is holding its breath in anticipation. And instead, there's a lot of trading going on this morning. Now, granted, we didn't go anywhere. So all that trading is positioning. And it apparently is multiple firms happily offering each the other side of the trade, right? So if we consider fair price, they must think this is a fair price because we didn't go anywhere, right? Neither side had to reach. There was just a lot of trading that took place on each side. And we're right where we started, basically, flat on the day. The numbers are going to affect the markets because it's the Fed's dot, right? The Fed is looking for data to cover their actions. They've been raising rates because they want to get inflation down. Well, how do they know they're getting inflation down? Or what part of inflation? So increased wages, that wage spiral that they were really worried about when every company out there couldn't seem to find workers and was paying a premium for new people that would come in and work for a company. And they were stealing people from other companies, offering higher and higher and higher wages just to keep employees in the door. Those costs get passed through it to everything, right? Those employees ain't going to eat it. They're going to put that cost into their product, which keeps everything in high and inflation running rampant. So if they keep raising rates and they cool off the labor market, then it shows that they're accomplishing something. They can look at the numbers and they can say, look, we're actually getting somewhere. So if they want to continue to raise rates, which most of them have said they want to raise rates more, they don't think they're done and they don't want to stop too soon, then they need cover to be able to say, yeah, everybody's crying. Everybody keeps telling us that we need to stop raising rates, but we're not going to stop because, gosh, look at the non-farm payroll numbers. It still shows, and then they can point to whatever the numbers show. When it comes to the consensus estimate, it's a little funny how they do that. They just ask a bunch of people, right? Hey, Joe, what do you think the numbers are going to be? And they, Sally, what do you got? What do you think the numbers are going to be? And then after asking 10 or 20 people, they say, okay, well, here's the average. Here's the consensus. Everybody thinks it's going to be 230. The thing is, sometimes everybody's wrong. They'll all read the same report. They'll all be honed in on something like the Teamsters and the strikes or Amazon or Walmart, some big name, and they'll just completely be blindsided by the numbers. The numbers one way or the other on one data dot plot, it's not going to matter in the bigger picture. But for us traders on a single day, you get everybody off sides and they all think they know. And it turns out they're all wrong. They're all scrambling for the exit at the same time. And the analogy that I used yesterday when I was talking to somebody about a completely different topic is, what's fair price on something? If you have 10 people selling something and only one person trying to buy it, you can haggle yourself a pretty good deal. But when you got 10 people trying to buy and only one seller, price can go up real fast. So if everybody is caught off sides and are surprised, markets don't like surprise. That's where we're very likely going to get a really big move. Think of it when we have a big event coming like FOMC and everybody says, oh man, FOMC is coming. It's going to be such a big move. If everybody thinks it's going to be a big move, we don't get a big move because they hedge the holy hell out of it. Nobody's caught off sides because nobody's scared because everybody bought insurance. And then no big move comes because, well, nobody was caught off sides. And so we didn't get a big move. What I like to do on non-farm payrolls, on CPI, PPI, is I listen to Bloomberg. It's usually my morning thing anyways. Usually get, like a rundown of what happened in Asia, what's going on in Europe. And then they start talking about our morning as things open up. And what I like to listen for is their confidence in the numbers that we're about to get for CPI, PPI, non-farm payrolls. And when they start getting arrogant and cocky, like they know the numbers, it's going to be 230 today. That's the consensus. It's the estimate. They know. The more cocky and arrogant they are, the more anticipation I have that they're going to be wrong. They're on the wrong side, and we'll get a big move. It doesn't always work, but it's a nice gauge. So the numbers are a little elevated, showing participation. We had a small move through the kill zone between that 2 and 4 a.m. time frame, but that was already reset. That was my trade of the day. I've been up way too late or way too early, I guess, depending on how you want to look at it. Just one of those days. 10-day, 30-minute volume profile. When we're at the low, we expect to go to the high. When we're at the high, we expect to go to the low. The shape of this profile as it looks right now is not how it looks. It's not how it looked when we got to the high up here. And it's not how it looked when we got to the low down here. Just keep in mind that the thing is dynamic. It is constantly moving. We don't see it move because it's a 10-day indicator. But every candle that we get on the right eliminates a candle that we had on the left. So by next Wednesday, unless we revisit these lows, all of this data back here below that red line will be gone. It won't be showing anymore. And to kind of demonstrate what the profile would look like at that point, that would be our new low of the profile. So you can imagine if price continues to go up from here, next week on Wednesday, when I make that statement about when we're at the highs, we go to the low, and we're at the low, we go to the highs, that will have been the low at that point. We'll be sitting somewhere up here, and it will look like we went from the lows to the highs. When in reality, we didn't get to the bottom of it. The bottom came to us long after we were gone. I know that's a little confusing. One way to wrap your head around it is take a picture of this thing every day at the same time. Do it for a month or 2 months. And at the end of that, look back at those pictures from day after day after day after day. And what you're going to kind of catch on to is that it's only valuable at this particular second in time, right now, because that wasn't the high when we got there. And that wasn't the low when we got there. It's not like we were watching it that day as it ran into the high and we said, oh, we're at the high. Just like that wasn't the low, but it will be the low if we continue to go up. So you can't look at this and say, well, I'm going to prepare for a move to the upside, and that'll be the high, whatever. Something to think about. Just take a picture of it every day for a month or two. And then after you have a nice collection of them, look at them back to back to back to back in a row. Then you'll understand what I'm talking about. Otherwise, we still have this shallow area. That is an air pocket of risk. We went through that pocket really fast. So we know there was nothing there to hit. Right? And this little build of liquidity wasn't there when we went through it the first time. But then we fell back and there was nothing that we hit here. There was no pivot there. But we hit something either in this market or in a correlated market and we bounced up from it. We actually overshot it and then hit something else. And we had all of this liquidity, which helped build that out. And then we broke through it and down we went. And now we have a pivot here, but we didn't have a pivot there. We know there was no pivot because we went through it the first time. So there's a correlated market somewhere or an inversely correlated market. I still don't know which that reacted to this move. And that's what moved the S&P. If we break through yesterday's high, that 44.50, it's not yesterday's high, but that 44.50 level, we should be able to move back through this zone relatively easy. Should. We moved through there before. If we continue to build out that area around that 44.65 zone, then there might be some trouble getting back through that cluster. Otherwise, I think we can get back through it pretty easy, right? I hate using the word easy, but it'll do. 44.18 is really close to 44.11 cog line. So there is some structure down there. If we break the point of control, got an expectation that we're just going to go to the roundy. It becomes like inevitability. 10-day, 30-minute volume profile. We don't have let me rephrase that. 5-day, 5-minute, call it the 5x5. Each day has its own profile. We don't have a VPOC from yesterday. V stands for virgin. That would be a virgin point of control, VPOC. It's not a VPOC because we've hit it over and over and over in the overnight. In fact, we crossed through it so many times that there just isn't one. So no reason to carry that one forward. We still have the one from Wednesday. We do have one underneath this, but it's the cog line. So you can mark it as VPOC, but you could also just recognize that 4411 is the cog line, and that way you don't have to mark it. It's a level that we already know is there. We have next week's weekly expected move showing already. The thing is, there's a difference between seeing it and knowing that it's locked into place. So this one isn't locked into place yet. It'll move through the day as price moves through the day. And after 4:15, it will be set in stone. So wherever it stops at that point, that'll be where it is. But even right now, we can still get value out of it. We can see first by asking, what was the range this week? And remember, it's a short week. Compare that to next week's range. Now, because this week was short and next week is a full week, it makes sense that next week's range is a little bit bigger. So seeing that it's a little bigger, not a surprise. We wouldn't look at this and say, oh, wow, look, they're pricing in volatility. I don't think they are. I think that's just the day that we were missing. If we had seen that it was an even smaller week, even though it was going to be a 5-day week next week, that would tell us something. But at this point, all we can see is that it looks pretty normalized that they brought that 1 day back in for next week and that the volatility really hasn't changed that much. But through the day today, we really want to keep an eye on it because yesterday the VIX was acting a little wonky. So let's see if there's some stabilization in the VIX market. Remember what the VIX is. I'm going to give you the simplistic version of VIX in its most basic form. It's just SPX options volume at 30 days out. That's it. Options volume. Now it's a mathematical formula, and we can get into least squared methods and the square root of time, but there's no reason to nerd out on it any more than just to say the VIX is just volume. That's it. So it's a volume gauge. I did a volatility school with 20 videos, and yet I can sum it all up into that one sentence. It's just volume. 10-week moving average, we're 2.5% above it. We are in this weird position. If we were expecting the curve, right, where, like a sine wave kind of deal, then after we topped out, we should have come down and reset again. And instead, we have this kind of failed, this failure to complete the curve. It was a lower high, that's true, from this one, but it still hasn't completed the rollover. So we kind of got an expectation that we need to revisit that 10-week, which would also be like the 50-day. But if we were asking, did we move too far, too fast with that big drop to the downside? Nope. Not too far, not too fast. We're not out of line. We're not overbought. We're not oversold. Nothing like that. So nothing to see here. This is the weekly. Go ahead and swap it over to the daily. Being able to ask the same question, and you can see that we're there, right? The kind of zoom in here. We are at the 10-week. I mean, we're sitting on it right now. So we've completed the curve. To give you like a visual, and you think about the way, price interacts with the moving average when it's trending. The blue line on my chart there in all of this mess is the 10. So we're talking about, price getting a surge and momentum. So crossing through the 10, running above it, coming back to bounce off of it, running, bounce, failure. And remember, moving averages aren't support and resistance. That's not what they're for, right? But they are really valuable when you're trying to decide if you're going to stay into something, if you're going to put a label on something. Like we tell the kids all the time, right? Use your words. Bullish strength in a bullish trend with decreasing bullish momentum, and the bearish surge is increasing. And we're able to put all of those labels onto this by using those moving averages, right? By having the rules in place that go with the language. So that's where the moving averages really get their value. The reason we're keeping track of the 10 is just mean reversion, linear regression. If you get too far away from the 10, if you're too overextended, it's very likely that the market's going to pause there and come back, right? And that's why you can see a market going up and the VIX go up at the same time. It's usually because the market starts to realize that it's getting way over its skis, and they'll start pricing in a fall before a fall is even imminent, because we're getting too overbought or too oversold, too far away. We have a market maker move today. So the average daily range right now is, I'm going to round up and say 1%. They're offering another 0.5% today. So the lines for that would be 44.83 to the upside, which is 40 points higher, and 43.99 to the downside. So basically from 4,400 to 44.85, just for some nice round numbers. But that only covers the ADR. It doesn't add another 0.5%. Now, when it comes to the 0.5%, we can go 0.5% in one direction very easily. So from the yellow line, we would want to add in another $23. Just call it 20 for the moment. That would take us to 4,500. If you add in, the change on each of those, you're talking about 45.11. That's the cog line. But you'd have to get through the previous week's high, and you'd have to get through that dark green line, which is, I believe they call that the forest line. It's whatever. I didn't name it. Getting through that level is going to be really difficult. So while the ADR says that we could go to 45.11 when we add it to the market maker move today, I think getting through the previous week's high and that voodoo line at the same time is going to be a task too much to ask. I don't see it. To the downside. Oh, and we'd have to get through the voodoo line also at that 44.75. All right. And we'd have to get the inside day breakout. So all those and this and that, plus there's a voodoo line here too at 44.60. It's a more minor voodoo line, but it's still there. So a whole lot of junk to get through. Having said that, we could still get to that 4,500 today, no problem. And I'm not reaching, right? That's it. I'm inside. To the downside, we have the previous week's low. We just add that $23, or subtract in this case, $25 from the round number at 4,400. That would give us 43.75, which is just above the previous week's low. If we get that close, we're going to hit it, right? So the low end today is the previous week's low. The high end today is the previous week's high. That's really simple, right? You can't ask for it any better than that. I like it. It's easy to remember. It's also easy to mark. Just go out to your weekly chart, mark a line at the high, market line at the low, that's today's range. That's easy. Now, trying to look through all the typical stuff before an event like this is an absolute waste of time. So we're not going to do it. We can, at a glance, see that I got nothing here, right? I mean, there's nothing across the board. What you do want to look for after these numbers come out is the overall market sentiment. Like yesterday, we had the morning briefing yesterday was jobs 1, and this is jobs 2, right? That was the title of yesterday. That's the title for today. The numbers yesterday were enough to take control of the market. And it was the only thing that was driving price yesterday is that structure, right? That entire conversation. It's going to be the same thing today. So the information that you're looking for on what kind of day it is, after the data comes out, don't bother trying to analyze the chart and figure out what today's going to be like. Take a few minutes to really dig into what the news is talking about and how the market feels about these numbers that came in today. If they're hot or not, if it was a surprise or not, and what it means to the Fed on whether or not they're going to raise rates. Because right now, the consensus is that they're going to raise rates at like a 80% certainty that that's how certain the market is. Well, if they're wrong about today's non-farm payrolls, they might be wrong about that 80% too. And if they start unwinding that, we could see the previous week's high easy today. All right, so we had the dollar calm down and bonds are still inside day. So far, so good. And the 10-year is still inside day. So without extreme moves, we would really want to see this 10-year back away, right? Like nice and easy. Just back away. Maybe get back down below that 3.9 and really get back into the 3.7s would be nice, but not today, right? We don't want to see this thing make any sudden moves. So a calm, gentle descent away from this 4 area is really what we want to see. And it can take the dollar with it as far as we're concerned, right? So yesterday, the dollar really started to wake up like that sucker was about to go. And it was interesting that it didn't make it past that 103.5 for more than a few minutes before it took a beat down, WWF style. Now we just need to follow through to the downside. Nice and easy though, right? Same thing as with the 10-year. We don't want this thing making sudden moves. We just want to see it hold the line. If we can get these two to not move around today, just sit still and maybe fade a little bit, can get a nice rally in the S&P that could go with our non-farm payroll data and drive us right up to the previous week's high. Speaking of the previous week's high, how we close on the week this week is going to be important for next week. So for all of you that are getting all bared up, right, just remember that we had a big, massive gapping week, and then we had a negative week, and then another positive and another negative one. And we are IX10 now. But if we're using OCR analysis, we're also looking at a market that has provided higher highs and higher lows. Now, the current week is going to give us lower highs and a lower close, but still a higher low. So we're getting a little bit of a wedge here. And if I was to get off of a weekly and put it onto a smaller time frame, that wedge is clear. But we're IX10. So we're inside this June 12 candle. And the longer we stay inside this, the more energy we're building up. We're winding up more and more and more and more energy. But the longer we stay inside this, the closer this 10 is getting to us, right? This is a way to reset the 10 without actually falling back down to it. Have you ever used that RSI Laguerre, right? It's that polynomial tool. When they say it's not rocket science, yeah, well, the math that's in that thing is rocket science math. What we figured out from using the RSI Laguerre is that when a market is moving around, it might move to get energy and it might move to expend energy. And we were able to determine which one it was doing. I mean, wouldn't you like to know that a market is moving with energy behind it rather than moving to get energy? The difference would be if you throw a ball to your son. You put the energy behind it, you throw it. If you didn't give it enough go, it won't reach its destination. As it travels, it's slowing down and it eventually stops. Take a ball and drop it off the top of a really, really big building. As it falls, it picks up speed. So one of those balls is moving but expending energy and it's slowing down. The other one is moving and picking up energy as it goes. Price does the same thing. And when you're using the RSI Laguerre, you can gauge which one it is that it's doing. One thing that we learned using that indicator is that when a market pauses like this and builds itself into an IX10 or into a range like this, that it's building up energy. And energy is a weird word that you don't normally find in markets, right? You hear about inertia, trend, momentum, but you rarely ever really come across indicators that talk about energy. If you do go searching for it, Doc Severson wrote a book about it, right? And really kind of laid it out nicely. So it's called the RSI Laguerre. It's a really interesting tool. The point of all of that is to say that we're in this range. And the longer we stay in this range, the more energy we're building up. And with the 10 moving up to us like it is, it's building up all this energy with a platform to bounce on. Easily taking us into 47 area, 47.5, not in a day, obviously, right? These are weekly candles we're talking about here. But it's one of the reasons that I took advantage of this negative week to close those short calls in the MES that I was holding. I want to see us make a good move to the upside first. Then I'll think about selling some more S&P calls. The ES and the MES naked options, just absolutely amazing. All right, guys, less than 10 minutes. We're going to get the data. There's no reason to crawl through all of the other stuff because nothing's going to matter until we get that data. And then the direction on the day will be solely dependent on how the market reacts to that data. So be careful, be safe, have a good weekend. I will see you all next week.